What's up, guys? Welcome back to another episode of Thompson's Two Cents. I'll be here every Friday post close, kind of give you guys my thoughts on the markets, mainly through the lens of ETFs, but also just reviewing the markets and providing nuance and context that I think doesn't always pan itself out to Twitter. So, here to share some ideas today and kind of break down the market, kind of show you what I'm seeing and some of the internal battles I'm struggling with as a trader and as an investor because I think, right, we're in a bull market. The market looks great, but there's still things that we need to work through. So let's just get into it, starting with classic overview of the S&P 500. So taking a look here, guys, I'm just looking at a daily chart of the S&P for about a year and a half. And the reason I look at this chart is to highlight a few things. You'll see in the top panel, we have the S&P 500% above a 20-day moving average. And then in the bottom panel, we have the S&P 500% from that 20-day moving average. And so what I'm doing here is everyone is aware that the market is going up, and a lot of the areas of the market are going up, which is something I'll dive into a little bit. The question is, using that top panel, when you had 80% of stocks above their 20-day, that is not something that lasts, right? It tends to ebbs and flow, especially even in bull markets. What we have is we have rotation in between different sectors and different factors, right? But that still keeps the market going up over time. And so last week we tagged that $80 level, 80% level. And my thought process was, okay, we've seen risk on movement. We've seen momentum do well. We've basically seen, right, 4 out of 5 stocks are going up. What do I want to do with my allocation? Do I want to keep allocating to maybe some of those high beta plays or some of those bottom fishing trades like home builders? Or do I want to stick with leadership and momentum such as, right, semiconductors, right, things in those spaces? So the point of this chart is to not for it to get bearish when we get to that 80% level, but it's to understand that as that pulls back a little bit, you might want to just assess the risk in your account and understand that, hey, you're not that good at this, right? None of us are that good at it, that 80% of the stocks we own should be going up. So it's okay, how am I going to divvy up my account going forward? So I do think, right, this is still a strong market, which is what that 80% highlights. It highlights the strength, right, that we have in the market. And so if a pullback does come, I think it's still from a position of strength, and that would be an opportunity. Hopefully that comes with bad sentiment. It comes with people being pessimistic about the market because that's what we love to see, right? So one of the reasons I'm bullish a pullback, right? If a pullback does come, right, the correlations kind of shrink a little bit. It becomes a little bit of a stock pickers market, right? It's not 80% of stocks going up. Maybe it's 50%, right? A little half and half. The reason I'm bullish is because if you look at something like the S&P 500 new highs minus new lows, right? You can do this with the NASDAQ composite and also the NYSE index. Last Thursday, before the holiday, we made year-to-date highs. And the point that highlights to me is we made all-time highs in the S&P 500, and we also coupled that with year-to-date highs in, the explosion of new highs. And what I liked about that is the fact that if we do, like I said, see that pullback, it's from a position of strength where that would be opportunistic. The other piece I will highlight too is when people are talking about maybe the market, right, being frothy or we've come a long way quickly. Those things can be true. But the next question you got to ask is, does that mean it's over, right? And the answer is no, because if you just look at this chart, you can see during a bull market, right, the new highs and new lows looks like it's just getting started. And I think that's something that people just aren't paying attention to is that new highs and new lows are just now expanding. And so, yes, not all the stocks are going to win, which is always the case, but I think we might just be getting started in terms of this leg of the market. Another chart to highlight a similar subject here and talk about the nuance within the market is S&P 500% of stocks above a 200-day moving average, right? And then also above a 20-day moving average. So, right, shorter term, going to see a lot more fluctuations. Longer term, that's going to be your longer term trend that a lot of people are focused on, investors particularly, right? Understanding, right, we're above that 50 threshold, which a lot of people kind of view as, okay, it's a green light. The thing I want to highlight here is when we made new all-time highs a couple weeks ago, people were talking about breadth not confirming, which sure, to some degree, breadth wasn't confirming in certain aspects. But what people were doing, if you highlight this bottom panel specifically, the S&P 500 above a 200-day, is they were confusing, right, non-confirmation from breadth with weakness in breadth. When breadth has been improving all along this during this rally, just like the market cap indexes have, right? It just wasn't confirming the move. And what you can see in the top panel here is that getting above 80 is we had that thrust from this breadth, right? So I think that's the piece that when you're in a bull market, you have to provide context to these types of measures, because there's always going to be people that want to get bearish when we make new highs because it seems sexy. It feels great to sell the last high, but highs tend to produce more highs. So it's just not a winning game typically. And so that's what the goal here is to highlight, is just that breadth is still improving underneath the surface, and it being at 62%, it really has plenty of room to the upside. I mean, 60% of stocks within the S&P 500 are above their 200-day, so 40% still have room to get there, right? And so that means some of these stocks that got above their 20-day were stocks that weren't above their 200-day. And so that's that short-term momentum that we saw in the market, right? And so the question is, do those stocks that are below their 200-day, is that where you allocate for that catch-up trade, or do you stay in the ones that have that momentum lead? And that's kind of a question I have through a few charts here we'll take a look at, is that beta versus momentum play. So let's take a look at that real quick. This chart here, I believe, highlights kind of the scenario I'm talking about. So in the red, you have Ethereum versus Bitcoin. And as we know, Ethereum's been a dog until recently, right? Until April, Ethereum's been a turd, right? And then Bitcoin has been just consolidating, doing nothing, but still overall a good looking trend. And I would say the same thing for beta versus momentum, right? Beta was just kind of chopping sideways, not really doing anything, but momentum looked great and has looked great. And what we've seen since the April low is we've seen risk, right? Beta is essentially the measurement of the volatility of the stocks that are in that index, right? In that ETF, SPHB, right? And the momentum is the measure of the trend, right? The distance that the stock has gone over a period of time, right? And the ones that have traveled faster, right, tend to be in that ETF. And so what we're looking at here is that volatility and risk, people have been buying risk. Another sign to me that the bottom that we had, one, is in, but two, that when people express this risk thesis, it's not because they're worried about a recession or even worried about a pullback. I think those, like I said, are going to be those opportunities to buy. No one knows, right? I see a lot of price targets out there. No one knows where we're going to go. But it's more, do you have a game plan when we see a pullback, or if we continue higher to allocate resources? So this is just a chart that highlights that, right? Like you have this beta chase, right? You have this risk chase, this risk on chase that's taking place in the market. And how long does that last? Because it's not going to last forever. And so do you want to continue to allocate there, or, right, to those momentum names? One of those areas of the markets that's crushing it right now is Bitcoin. And I think Bitcoin is a great example of zoom out, chill out chart, right? It's a great example of that. If you look at Bitcoin here, what we're seeing is that you have these basing patterns after every election, and most recently Trump's election, and we're breaking out to new all-time highs here, this 117, 118, $118,000 in Bitcoin, and the trend could just be getting going. So that's kind of what I'm trying to highlight here, is you can take short-term evidence that we might be overbought, but then zoom out and see we might just be getting started. So those opportunities and pullbacks that come may be actual opportunities instead of risk in the market. So I love this Bitcoin chart. I'm long Bitcoin. I think everyone's aware that it's breaking out to new all-time highs now. But I think that's risk on. I think that's a leading indicator of what is to come for the market overall. even if there is maybe some short-term pullback or decorrelation between all the stocks that are in it. This chart here, right, looking at, speaking of that risk on, that junky feel that people have in the market, it's not where I tend to play, but there's money to be made there. I have traded some bottoms, which I've talked about home builders in the past, but one of them this week, right, is MOS, a cannabis ETF, right? It's up 22% this week, roughly. And that to me is something that you can look at this chart. One of the largest 1 week rate of changes it's had. You had a RSI divergence, right, where price, kind of made a double bottom, but then momentum made a higher low. So you kind of had this bottoming pattern you could have traded. But this to me just symbolizes why 80% of stocks are going up is because everything at this moment was working. And so just be aware that I don't know if this is a new trend yet, right? It's 3 weeks of great performance, but this is still in a long-term downtrend. So make sure you're aligning that time frame for what you're trying to look at, because this is that beta chase, right? This is beta. This is stuff that goes down a lot when the market goes down, goes up a lot more when the market goes up. But it's not necessarily a trend change yet, right? This isn't momentum, right? This is just beta, maybe short covering that's taking place. In terms of areas of the market, right? We're talking about risk on behavior, right? That rotation we've seen into risk. Two of those areas I think of is microcaps and regional banks, right? I was talking earlier today with some people about it, and I think of this like football, right? These are the backups, right? You think about microcaps and regional banks, right? I don't compare regional banks to Goldman Sachs, JP Morgan, Morgan Stanley, right? Those are the starters. These are the backups. These are the smaller banks that have, a lot of rate sensitive risk, right? They have a lot of cyclical risk. Same thing with microcaps. No pricing power, no ability to have economies of scale just yet, right? Their debt is typically going to be the worst type of debt in terms of the financing they have around it from fundamental perspective. But that's what people have been buying. And so if people are buying risky areas of the markets, right, they're buying the backups, it's not because they're worried about recessionary fears or they're worried about the tariffs per se, right? Because these companies will get whacked by tariffs in theory, right? Like a microcap company that has, $20 million in inventory coming from China because it's the cheapest place to source it would not be going up if, right, the tariff was a concern here. And so this is where those intermarket relationships just help you understand that the behavior we're seeing is being confirmed intramarket and by the cap scale and risks that people are taking. The other thing I'll highlight here is this is basically much the same trade, right? Buying microcaps and regional banks. And right, microcaps aren't in the regional bank ETF and regional banks aren't in the microcap ETF, but you can see they tend to trade together because it's just risk, right? It's a beta play. And so understanding that you might not necessarily put on, 15 different microcap names and 15 different regional banks because they're probably all correlated. So if there is a rotation out of, right, some of the beta, all of those stocks to some degree are probably going to go down. We'll say 80% of those, right? And if you take all your money and you're like, oh, I rotated out of the momentum, the leadership into these beta plays, now you're at a point where your portfolio is a little messed up, because I think it's really simple to overthink a bull market and try to do too much. And that's what I'm trying to highlight here. You don't have to do too much. You just have to be in those allocations. And even indexes, right? Indexes have a large allocation to tech, which has been leadership, industrials, which has been leadership, financials, which has been leadership. And it has a little bit of allocation towards materials, which has been a strong beta play, right? Strong recovery in materials. And so you get some of that within some of those indexes. So yeah, don't necessarily have to overthink the bull market as much as people are doing. Next thing I wanted to highlight that throws a wrench in the breadth story and kind of whether or not, right, we have to see the market pull back is the Mag 7, right? This is the elephant in the room for the market cap weighted indexes is the Mags, right? Tesla, Nvidia, Amazon, Google, Apple, Meta. What these stocks do tend to dictate the market to a large degree, especially the market cap weighted indexes. They make up 35% of the market cap S&P 500. And so at certain points you can have breadth, right, which we saw, percent above a 20-day is about 67% now. It was at 80, so we're seeing breadth kind of pull in a little bit. But if the Mag 7 break out of this range they're in, right, they're just kind of slow and steady going up. Breadth doesn't necessarily matter from a market cap weighted perspective. It matters from a stock allocation perspective for individual stocks. But if these are going up, it's going to lift the tide of the S&P 500 overall, which we've seen in the past. We've seen in the past where we've had stocks, above 80% and correct, and the markets still go higher because the Mag 7 names are going higher. So that's a little bit of the nuance you have to understand with breadth. But overall, this is another thing for me. Hasn't made all-time highs yet. Plenty of room to work, right? Gives you that allocation equally to these names. Great ETF just to watch overall to understand kind of the context. And looks good, right? It's just RSI is in that bullish regime above 70, above 50, and just kind of trading sideways. The bulls are just kind of maintaining this slow drip upward, which we typically see during the summers. As I mentioned, this is the beta play, right? These two charts, right? The Russell 2000 and microcaps, these are the bench warmers. These are the backups. These are the stocks that, right, tend to do well, right? Early in recoveries, early during those initial thrust. And we've seen that. We've seen the Russell 2000, right, break its diagonal trend, recover back above the 200-day, recent AVWAP, bullish regime. The question is, during this pullback, when it gets punched in the mouth, can it maintain these levels? And the level to watch for me is a 200-day and the recent AVWAP, right? This 215 to 209 level, if it kind of pulls back to that level, and that can serve as, the leg for the next leg higher. But in general, this recovery here is something that you have to continue to watch because this risk-on behavior is confirming the bullish action that we've seen. So that's what I have for this Russell 2000 chart, what I'm highlighting. And then same thing with the microcaps. Like these are the backups, guys. Like if people are buying this, things are going to be okay. And so I think you just continue to watch these levels, continue to just kind of monitor the microcaps and the small caps to kind of understand the bridge that they're building in the market. Next thing I wanted to highlight is kind of the S&P 500, right? And comparing home builders and semiconductors. I kind of come from a CPA background, as a lot of people are aware. And one thing I like to look at here is home builders and home construction. To me, they have different allocations within both of those indexes, ETFs, and then semiconductors, right? And so you think of the technology economy. And then for me, home builders and home construction is a consumer economy, right? A lot of consumer discretionary spend there. I know people right now, when people are buying homes and they feel like they can afford their home, that's when sentiment is good, right? And when people don't feel that way, that tends to be when sentiment is bad. And that's what people are doing, right? Is we want to see bulls in a bull market, right? We don't want sentiment to get extreme, but we want to see bulls in a bull market. And so this is one of those charts that I think highlights the overall theme of that momentum versus that catch-up trade. Like, will that catch-up trade continue? And so you can see here these home builders and home construction have done a great job catching up recently, right? Recovering from those lows. And that's kind of been what's allowed 80% of stocks to be above their 20 days, right? Because these are ones that are above their 20 days and starting to get back above their 200-day. So follow through there would just be more confirmation that, right, breadth is continuing to expand. We're continuing to see the improvements in the market that we wanted to see. And right, the S&P 500 leading isn't a bad thing. I think we need the participation of the home builders in this market. Because if you look at this chart, look at the red and purple lines, you'd actually see they led the market lower. They were kind of the canary in the coal mine in terms of back in February when they were making lows and, right, semiconductors and the S&P 500 were trading sideways. The market gave you information. It gave you signals to understand that, hey, something is happening here and you should be aware of it. So seeing them recover here is just more confirmation that, the economy is doing okay, right? Like this area of the market is telling us is going to be okay. Why? Who knows? We'll learn about it in a couple weeks, couple months, but overall, it's doing okay. So for me, I'm playing both of these, right? I am in the home construction, home builder ETFs, right? I still see an allocation there because I use trailing stops. I'm not proactive in getting out of names typically. But I also really like the idea of sticking with what's worked and sticking with stocks that have already made all-time highs and are possibly in the pullback range. So I'll just give you guys one trade that I'm eyeing right now in terms of that. That's been a strong sector. It's been an area of the market that's done really well. It has the winds at its back, but it's kind of pulled back a little bit this week to kind of polarity zone where I think, right, it could be a potential buy. And there I am talking about is communication services. So you look at this communication service chart, right? We had the breakout to all-time highs. I believe it was the first ETF of the 11 S&P 500 spider ETFs to break out to all-time highs. And what have we seen? We've kind of seen a lot more junk get bought the past, we'll say 10 days in the market, past 2 weeks in the market. Like I mentioned, the cannabis ETF. There's been some random casino ETFs. There's been flying car ETFs that don't have flying cars that are just breaking out. We've seen junk get bought, right? And I think this pullback here, right? It's RSI staying above 50. We're getting back to this 105 level. These are the types of setups that when people said don't chase when S&P 500 was getting to 80% above its 20-day and was kind of getting a little bit stretched from its 5-day moving average, that's what they meant. They meant don't buy it when you have a doji candle and then a reversal. But now, if we see strength, right? This Friday we saw, right? We saw a little bit of a hammer candle is what they would call this. When you see that hammer candle and then you see that follow through, these are the areas of the market that I'm interested in then future allocations to. Because, right, if you don't want to buy all-time highs, you can buy those breakout retests because you tend to get, right, pretty decent risk reward against that 105 level. But also in bull markets, if you're someone that wants to let it run a little bit more, you can use this 200-day, which actually lines up with the prior all-time high AVWAP around $100, right? So that's what another $6 lower. Could be another risk level that you use to manage here. But communication services, also throw out financials. There's some nuclear names, right, that this past week showed a little red, showed a little bit of a pullback. But I believe those could be areas of the market if momentum, because I think momentum during the mid-cycle of a bull market stays intact, whereas beta is a little bit more sketchy, right? It is what it is, right? It has volatility associated with it, and sometimes people might want to get out of that junk. So I'm looking for more allocation into these momentum names that might pull back a little bit than I am into some of that junk area of the market, other than the stuff I'm already in that I have trailing stops in. So that's kind of how I'm seeing it this week, guys. That's kind of what I wanted to review, was just go over, right, the context of what overbought might be in the market here, right? And if we see this pullback, what areas of the market might lead that pullback and where opportunities might exist. Because I'm a reactionary trader, right? Just like studying film for a football game, what you do is you analyze and you see and you anticipate the plays that are going to occur, and then you react once they do. And the person who has the best game plan and has studied the film the most, studied the charts, right, can tend to react a little bit quicker, and that can be the difference, right, between making money in the market. So, guys, let me know what names you're looking at in the comments, and make sure to follow us at Hostile Charts, and make sure to sign up for my newsletter. Comes out, send out a note every Sunday. It's the Sunday stock list. And then Tuesday, Thursdays, Thompson 2 cents. I'll put a link below for that after the show. But hope you guys have a great Friday. Cheers.